Good afternoon, ladies and gentlemen, and members of the press. I welcome you to the Central Bank of Nigeria today. The Monetary Policy Committee met on the 22nd and the 23rd of July 2019 in an environment of subdued global growth and fragile domestic economic recovery. The committee reviewed developments in the global and domestic macroeconomy. It noted that the global environment is overwhelmed with vulnerabilities and financial fragilities. Inflation in the advanced economies trending downwards and significantly below the long-run objective, necessitating the adoption of accommodative monetary policy. The global economy is poised to see another round of loose monetary policy. All 11 members in attendance were at this meeting. The global economic development. Global output growth remained weak, with persistent headwinds expected to continue for the rest of the year. Key amongst these headwinds is the rising trade tensions, particularly between the United States and its key trading partners in Europe, Canada, China, and India, rising debt levels in some advanced economies and emerging markets and developing economies, as well as growing political uncertainties across several regions. Consequently, the International Monetary Fund downgraded its 2019 global growth forecast from 3.6% to 3.3%. Price developments across the major advanced economies remain muted alongside softening output growth. In the emerging market and developing economies, however, inflationary developments were mixed in response to challenging macroeconomic conditions. The committee noted that the return to monetary policy accommodation by the advanced economies could see a new wave of capital flows to the emerging markets and developing economies as investors continue to search for higher yields. The domestic economic development. Available data from the National Bureau of Statistics (NBS) showed that real gross domestic product grew by 2.01% in the first quarter of 2019, driven by the non-oil sector, compared with 2.38% and 1.89% in the preceding and corresponding quarters of 2018, respectively. The committee noted the continued but moderate expansion in the economy, as indicated by the manufacturing and non-manufacturing purchasing managers indices, which grew from 27th and for the 27th and the 26th consecutive months in June 2019. The indices stood at 57.4 and 58.6 index points, respectively, in June 2019. Staff forecasts indicate a 2.11, 2.39, and 2.56% growth in GDP during the second, the third, and the fourth quarter of 2019, respectively, expected to be driven largely by the non-oil sector. The committee, however, noted that the downside risks to these projections to include low credit to the private sector, high unemployment, delayed intervention of fiscal policy, as well as low revenue and fiscal buffers, amongst others. The continued intervention by the bank in the real sector is, however, expected to partly ameliorate the downside risks only in the short run, while sound fiscal policy is expected to drive growth in the medium to the long run. Committee observed that broad money supply M3 grew by 4.97% in June 2019 from the level at the end of December 2018 at an annualized rate of 9.95%. It was also below the indicative benchmark of 16.08% for 2019. The growth in M3 was largely driven by the increase in net domestic credit (NDC), which grew by 17.26% in June 2019 from the level at the end of December 2018. The growth in the net domestic credit was accounted for by the significant increase in credit to government, which grew by 55.8%, while credit to the private sector grew by 9% in June 2019. The committee, however, noted the constrained growth in the monetary aggregates as an indication of weak financial intermediation in the banking system and called on the management of the CBN to sustain the various initiatives of the bank to improve lending to the private sector in Nigeria. The committee welcomed the moderation in headline inflation year-on-year to 11.22% in June 2019 from 11.4% in May 2019. This was attributed to the decline in the food and core components to 13.56 and 8.80% in June 2019 from 13.7 and 9.03% in May 2019 respectively. It noted the development has been partly due to the CBN's support to the agricultural sector and the prevailing stability in the Nigerian foreign exchange market. The MPC further noted that although inflation moderated in June 2019, the continued pressure on prices continued to be associated with structural factors such as the high cost of electricity, transport and production inputs. The MPC, however, expects that with the commencement of the harvest season, food prices will taper further downwards. It thus, however, advised that the security challenges in some parts of the country should be addressed urgently to increase agricultural produce in order to sustain the downward trend in inflation. The MPC thus reiterated its commitment to ensure the maintenance of price stability. The net liquidity position and interest rates in the economy reflected the impact of liquidity injections and the bank's liquidity management operations associated with fiscal federalism, transformation of maturing CBN bills, open market operations, auctions and foreign exchange interventions. Accordingly, the monthly weighted average interbank call and open buyback OBB rates oscillated around the MPR corridor, increasing to 8.38% and 8.71% in June 2019 from 5.14% and 8.34% in May 2019 respectively. Committee noted with concern the continued bearish trend in the equities segment of the capital market in spite of the sustained capital inflow to the economy, reflecting continued portfolio reallocation from equities to fixed income securities. Consequently, the all-share index declined by 9.11% to 28,566.79 index points on July 12, 2019, from 31,430.50 index points at the end of December 2018. Market capitalization, however, grew by 18.77% to 13.92 trillion on July 12, 2019, from 11.72 trillion at the end of December 2018. This was due largely to the additional listing of new firms during the review period. The committee welcomed the continued stability in the foreign exchange market and the steady accretion to external reserves, which stood at $44.88 billion as of July 19, 2019, 0.38% increase from $44.71 billion at the end of June 2019. The MPC also noted the steady moderation in non-performing loans ratio of the banking industry to 9.36% in June from 10.95% in May of 2019. While this remained above the prudential benchmark of 5%, its continuing moderation indicates the improved resilience of the banking system. Committee thus emphasized its resolve to further drive down the non-performing loans ratio in the industry so as to strengthen the strategic health of banks in the country. The outlook. The overall medium-term outlook for the global economy remains mixed, with indications of continued softening of global output due to persistent policy uncertainties and sustained macroeconomic vulnerabilities. These are likely to be accentuated by the increasing trade tensions between the U.S. and its major trading partners, rising debt levels, and geopolitical tensions. On the domestic economy, output growth in 2019 is expected to remain weak, peaking at 2.27%, while inflation is projected at 11.37% by the CBN staff projections by the end of 2019. The underlying arguments in favor of these projections include favorable oil prices, stable exchange rate, moderate inflationary pressures, enhanced flow of credit to the private sector, sustained CBN interventions in the real sector, effective implementation of the Economic Recovery and Growth Plan, building fiscal buffers, and improved security in the food-producing areas of the country. Committee's consideration. In its considerations, committee noted the need to boost output growth through sustained increase in consumer credit, mortgage loans, and granting of loans to our small and medium enterprise companies. It also observed that the management of the bank had begun the prescription of using benchmark loan-to-deposit ratios to redirect banks to focus on lending. To mitigate credit risks, the committee enjoined the management of the bank to de-risk the financial markets via the development of a reliable credit scoring system similar to what applies in the advanced countries, as this will encourage deposit money banks to safely grow their credit portfolios. The MPC called on the fiscal authorities to expedite action on expanding the tax base of the economy to improve government revenue and stem the growth in public borrowing. It further urged the fiscal authorities to build fiscal buffers to avert macroeconomic downturn in the event of a decline in oil prices. The committee also called on the bank to intensify efforts to encourage Nigerians in their diaspora to use official sources for home remittances, noting that the effort will complement other measures geared towards improving the current account balance of the nation. It enjoined the bank to consider introducing incentives such as the reduction of charges on diaspora home remittances into Nigeria. On the African Continental Free Trade Agreement (AfCFTA), the committee urged the federal government to put in place measures to aid the economy in realizing the benefits and full potentials of that agreement. In particular, it noted the need to resuscitate moribund industries in Nigeria and improve key infrastructure in order to strengthen the productive base of the economy, create jobs, opportunities, as well as boost exports. The committee noted the positive developments towards the creation of a common currency in the West African zone by January 2020 and commended the government and the central bank for pushing forward the initiative. The committee, however, enjoined the bank to ensure that Nigeria is properly positioned to maximize the benefits of monetary integration. In consideration of the specific policy options to adopt, whether to hold or loosen or tighten, the Monetary Policy Committee made the following observations. 1. That while the focus on growth was imperative, the mandate of price stability remains sacrosanct. 2. Given the happenings in the external sector and the fact that inflation is moderating, tightening of monetary policy should not be an option at this time, as restriction of the capacity of deposit money banks to create money could curtail their credit creation capabilities. On the contrary, Monetary Policy Committee was of the view that while loosening could increase money supply, stimulate aggregate demand, and strengthen domestic production, the economy could be awash with excess liquidity, especially if loosening drives growth in consumer credit without commensurate adjustment in aggregate output. On holding the current monetary policy position, the Monetary Policy Committee observed that given the recent actions of the bank's management involving the prescription of minimum lending threshold to the deposit money banks, it is safe to assume that this action, targeted at stimulating credit growth to the real sector, will increase credit delivery to the real sector and accelerate investments and economic growth. It also observed that since interest rates were currently trending downwards, it is safer to await the full impact of these policy actions on the economy before a review of the position of monetary policy. The committee's consideration. In consideration of the foregoing, the committee decided unanimously by a vote of all members present to retain monetary policy rate at 13.5% and hold all other policy parameters constant. Decision was informed by the conviction of members that key macroeconomic indicators are trending in the right direction, and because of the lag in the effect of policy actions on output. Consequently, the MPC unanimously voted 1. Retain MPR at 13.5%, 2. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR, 3. Retain the CRR at 22.5%, and 4. Retain the liquidity ratio at 30%. I thank you all for listening.